Hello, this is a synopsis about Chapter 7. This is a relatively short chapter with only 3 questions on the quiz, so it won't take too long to go over this. You can skip the first part, which is on closed-end mutual funds or closed-end investment companies. In the prior chapter, that was about mutual funds. I talked about closed-end mutual funds, and those are just most closed-end investment companies just have a specific number of shares that they, hang on, I'm trying to get this to just fix, to change here. Okay, so they just have a fixed amount of shares that are out there that are bought and sold. So as I mentioned with these closed-end mutual funds, they're not very common, but you can only, there's a fixed amount of shares. So with the way they trade in the market, they don't really trade at their net asset value. They usually sell either at a premium or a discount, depending on the demand. So anyway, they're not that common, so you can skip this section. All right, so this is where we're starting here. So when you're reading the chapter, start with REITs. So I've probably mentioned this briefly in other chapters, but REIT stands for a real estate investment trust. You can invest in individual companies that are REITs, or you can invest in mutual funds that invest in REITs, or ETFs that invest in REITs. I love REITs for diversification purposes. So by now you've learned about diversification, and you've also learned about correlation. The correlation can range from +1 to -1. +1 would mean that something is perfectly positively correlated. And so if you remember from prior chapters, the correlation coefficient just tells us if the correlation is negative or positive. It doesn't tell us the magnitude of it. But we use the correlation coefficient to figure out, I'm sorry, the correlation coefficient ranges from, let me back up. The correlation coefficient ranges from +1 to -1. So +1 is perfectly positively correlated. -1 is perfectly negatively correlated. So if you think about that, if you invested in two investments that moved in the exact same direction, that moved identical. For example, if you invested in ExxonMobil and Chevron, those are going to be pretty positively correlated. You don't get any diversification benefit there. A correlation coefficient of 0 would mean that they're just all over the place. There's really no pattern at all. A negative correlation coefficient, or a correlation coefficient of -1, that's what you're looking for. Impossible to get in the real world. That's what you're looking for, because a correlation coefficient of -1 against two investments would mean that they're perfectly negatively correlated. One is up, but the other is down. So that's where you get your maximum diversification benefits. Now, REITs have a low correlation. A lot of times REITs have a negative correlation with the market. So that's why they're really good for diversification. So for example, if you're working now and you have a retirement plan, a 401k plan, or when you do start working, you'll have a 401k plan. Well, you will have to probably pick the investments that you want to go into. Well, REITs are a really good way to diversify. Most of these 401k plans through employers have a real estate investment trust mutual fund. So I like to invest in REITs because they're not as risky as stocks in general. And a lot of times when stocks are down, the REITs are up, and vice versa. So what are REITs? Well, REITs are real estate investment trusts. They invest in real estate. So instead of and it's a good way to diversify, like I said. Also, some people don't want to invest in real estate directly because it's not very liquid. So you can have some exposure to real estate by investing in these real estate investment trusts. So what are they exactly? Well, they're companies that invest in shopping malls. It's commercial real estate mainly. Shopping malls, hotels, business, commercial properties, and so forth. So, and they're very liquid. So if you want to have exposure to real estate and diversify your portfolio, a REIT is a good way to go. Now, here on the next slide, they have some individual REITs. I've been talking right now, I've been mainly talking about investing in a mutual fund that invests in these REITs or an exchange traded fund that invests in REITs. But you could buy individual real estate investment trusts. NLA Capital is one that's very big. A couple that aren't mentioned here that I like is Chamora. You might want to look at that. It's called CMI. CMI is the ticker. Chamora is a REIT. And that's a really good REIT. And the other thing about these REITs is they typically pay a nice dividend. Boston Properties is another one. I think it might be BTX or BTI. I'm not sure of the ticker, but Boston Properties is a mortgage REIT. They typically invest in mortgages. So that's something just to keep on the back burner. You should know what REITs are and know, what their benefits are. All right, so that's REITs. So again, you can buy individual REITs, individual companies that are REITs. You can buy mutual funds that invest in REITs, and you can buy an exchange traded fund that invests in REITs. Okay, so this brings us to ETFs. What is an exchange traded fund? Well, an exchange traded fund is just like a mutual fund, except an exchange traded fund is typically based on an underlying index, though not always. The way these index funds first started out is they were based, or the way these ETFs first started out is they were based off of an index. So for example, the Standard & Poor's, the S&P 500 index, you can buy an exchange traded fund that mimics the S&P 500. It's called SPY. That's a really popular one. You've probably heard of that. You can also invest in an index fund that mimics that's based on the NASDAQ. The NASDAQ is the NASDAQ is basically it's not a physical stock market location, but it's basically a bunch of computers at different offices or different setups around the country, but it's not a physical exchange. But the NASDAQ, typically stocks that are on the NASDAQ are stocks that are high-tech type of stocks. So if you want to invest in technology but reduce your risk, you can invest in the Qs, QQQ, which is an exchange traded fund that is based on the NASDAQ. If you want to invest in an index fund that is based on the S&P 500, which is basically the 500 largest companies in the US, you would invest in the SPY. You can also invest in an index fund that mimics, or that is based off of the Dow. Now, the Dow Jones Industrial Average, that's the oldest index, and that's just 30 stocks that are in the Dow. I'm not sure of the ticker for the ETF. It might be DOW, might be DIJ, but that would be an ETF that is based off of the Dow Jones Industrial Average. So, the main difference between ETFs and mutual funds is that ETFs trade like stocks. I think I've mentioned this in a prior chapter, but anyway, it's worth repeating. So exchange traded funds, the price changes throughout the day. So people can buy and sell these just like stocks. That's why they're really a lot more popular than mutual funds. A mutual fund, like I said, it pools people's money and they invest in all these different stocks. Or if it's a mutual fund, can also be an index fund where they're based on the S&P 500, the Dow, or the NASDAQ. Those are the three biggest ones. You get the end of the day price. So if you buy if you went to your account today, if you have an account, say on Robinhood, Schwab, Fidelity, whatever, you went today and you bought an ETF, you bought SPY, which is the S&P 500 ETF, you're going to get the price right then. It's trading real time. But if you bought an S&P 500 mutual fund, you're not going to get the price. You're going to get the end of the day price, because what these mutual funds do is they add up the price of all the underlying securities at the end of the day after the market closes, and that's the price that you get. So if the market is going up, you'd get a better price with an ETF. But if the market's going down, you would want to sell. And if you had an ETF, you can get the current price. If you had a mutual fund and the market's going down, you would get the end of the day price. It might not be as good of a price. But most people who invest in mutual funds are long-term investors, so they don't really care. It's not a big deal. But what I've seen is that not many people invest in mutual funds anymore, unless it's, in my opinion, unless it's with your retirement plan. So most people prefer ETFs, but we're stuck with these mutual funds for the most part in our retirement plans. And so it's still good, it's still good to research mutual funds and to know about mutual funds. And I'm not against investing in mutual funds. If I find a mutual fund that I like, I'll go ahead and invest in it. But there's a lot of ETFs have just become more popular. Okay, so exchange traded funds, they trade throughout the day like a stock. So think of it as just like a mutual fund that trades like a stock. Now, they'll mention in the book that these ETFs are mainly based off of the underlying indices. However, ETFs have really expanded in recent years, and you can buy all different kinds of ETFs. You can buy ETFs that are based on foreign exchanges. So, for example, a lot of people, a lot of people own Apple stock, but they would like to own Samsung. Samsung being, the main competitor with Apple in the cell phone market. Well, we as Americans, we can't buy Samsung. That's a South Korean company, if you're not aware of that. But how can you have exposure to Samsung? Well, you can buy a Korean ETF. In other words, you can buy ETFs that are specific to a country. So you could buy the Korea ETF, and that will give you exposure to Samsung. You can find exchange traded funds that just invest in equities in a specific country. You can invest in ETFs that are based on specific sectors. So I'll give you a couple examples. OIH. OIH is an energy services ETF. Halliburton is one of the big ones that's in there. Schlumberger is in there. And so if you don't want to invest in these individual oil services companies, you can invest in the ETF. So as you can imagine, OIH has been down for years and years and years because oil's been down. Well, oil is undervalued, and it's been on the move in recent months. As of, again, the date of this is June 30th, 2021. The date of this synopsis here. And so for about the past 3-4 months, all of these stocks have really taken off. So it was a good time to invest in OIH. So I like to use these sector ETFs if I think that a particular sector or industry is undervalued. Oil is undervalued. The energy sector is undervalued. So if you think it's undervalued, buy some OIH instead of trying to buy individual companies, and you can and then you that's a good way to invest in the whole sector. Now these ETFs do have annual fees, so that's something to take into consideration. And the sector ETFs in particular are going to have higher annual fees than others. So keep in mind, when you're investing in individual equities, you have more risk, of course, but you don't have the fees. With these ETFs, you are going to have an annual fee, just like you would have with a mutual fund. OIH might have a fee of around 1%. So you got to take that into consideration when you're thinking about your returns. Another interesting ETF that is XLF. XLF is financial services ETF. So if you want to invest in some different banks are considered to be undervalued right around this time too. Again, it's June 30th, 2021. And so it's good just to invest in a couple banks, a couple of bank ETFs if you want to have that exposure. So that's one way to try to time the market too. I don't recommend ever timing the market. Timing the market means trying to buy things when they're buy low and sell high, so to speak. That doesn't always work out. But if you think that a whole sector is undervalued, then these ETFs are good tools to have to add them to your portfolio. Okay, so anyway, sector ETFs are ETFs in different industries. So you can buy energy, retail. For example, I was just researching one called iBuy. Retail is another undervalued sector because as of, again, June 2021, everyone's going back to work and they're going back to school. So I read this really interesting article. It was about Bank of America, and Bank of America has data where they track credit card purchases. And investors use this data to see what people are buying. And so they saw this huge uptick in retail sales because people are going back to work. So they're buying work clothes and they're going to be going back to school. So the retail sector is set to really go up. So you can buy individual stocks, like Gap, Target, Walmart, and all these Macy's individual retail stocks, or you can buy retail ETFs. Uh, an interesting one is called iBuy, IBUY. It's an ETF that just invests in online retailers. So those are some interesting things to just to jot down and follow if you're interested in investing. Okay, so anyway, enough about the sector ETFs. We all also then they're just mentioning a specific ETF on an index, based on an index. This is the NASDAQ ETF, QQQ, as I mentioned. You also have the S&P 500 ETF, which is um, uh, SPY. That's a very popular one. You also have the Dow Jones Industrial ETFs. There's another one, I forget the ticker, but it's on the Russell 2000 index. The Russell 2000 is small company stocks. Also, let me back up here to the sector. I mentioned this, I think, in the instructional video about the contest in the portfolio report. If you want to try to diversify your portfolio, some people like to invest in precious metals. So there's an ETF for gold. It's called GLD. There's an ETF for silver, SLV. So those are some other interesting ones to look at. Okay, then last and least, in my opinion, last and least are these leveraged ETFs. Would not touch these leveraged ETFs with a 10-foot pole. Leveraged ETFs are ETFs that um, their returns or their losses are are more than one times the market. That's why they call them leveraged ETFs. So, for example, you can buy a 2 times SPY fund. That means that if the S&P 500 or if the SPY goes up by 1% today, this 2 times SPY will go up by 2%. You can get a 3 times. You can get a 2 times and a 3 times SPY. So just to say you had this 3 times leveraged SPY fund, S&P 500 goes up by 1%, that leveraged ETF is going to go up by 3%. And they really get crazy out there. They also have leveraged sector ETFs, 1, 2, and 3 times. Then they have inverse leveraged ETFs. So let's say you wanted to make money when you thought the market was going to go down. You can get a 1 times inverse SPY, which means that if the S&P 500 goes down by 1%, you would be up 1%. So people have lost a ton of money on these leveraged ETFs because they're really volatile. And they also have something called it's called leakage, or I forget the term that they use. But basically, what happens here is these leveraged ETFs. Really, traders will use them if they just want to get in and get out really quickly. They're not these leveraged ETFs. If you buy and hold them, you're going to lose money. In other words, if you had say a 2 or 3 times 1, 2 or 3 times long ETF and a 1 and a 2 or 3 times short ETF, you could be losing money in both of them. And the reason is that the way they recalculate with the math, you end up with this loss. So let me explain what I mean. Let's say that let's say you're invested in the S&P 500 and let's say you're invested in the SPY and you have $100 in the SPY and the SPY goes down 5%. So you're down to $95 and then it goes up by 5%, or well, it'd have to go up by more than 5%, but let's say it goes down by $5 and then up by $5. So you're back at $100. You haven't lost any money. Well, if you had a leveraged SPY fund and it went down by a certain percentage and then went up, let's say it went down to where you're at 95 and then goes back up to the same price as when you bought it, you're not going to be back up to $100. So they have, I think it's called shrinkage or something, but anyway, what they found that happens with these leveraged ETFs is that if you hold them over the long run, over the long long duration, they're and if you have these up and down days, they you actually end up slowly losing money, and so people have lost a lot of money on them. I would not recommend investing in them. Some people, like I say, most people who buy these are traders who they're trying to guess the market and trying to just get in and get out. Okay, so anyway, this is just giving you to sum this up. This is just giving you some examples of ETFs. So you can buy ETFs that invest in foreign companies, and you can buy country ETFs. You can buy ETFs for different sectors, and then you can buy ETFs based on specific indices. Those are the main ones. And the most popular ones that you see out there, SPY and the Qs. I would say those are the two most popular ones. All right. Now you also have people who have a lot of money and maybe they own real estate and they have a stock account. They've got their, typical investment account like most of us do and like you will have one day. But they have a bunch of money and they want to invest in other things. So you've probably heard of hedge funds. So a hedge fund is a company that takes people's money and they're not required to do a lot of reporting. Like if you buy a mutual fund or if you buy an exchange traded fund, they're required by the SEC to report publicly what their holdings are and stuff. These hedge fund companies are private companies. They don't have the same reporting requirements. And so what these hedge funds will do, typically you have to have about $500,000 to get an account to give your money to one of these hedge funds. They typically charge 2 and 20%, which is ridiculous in my opinion. So what does the 2 and 20 mean? It means that if you gave them, let's say you had $1 million, if you gave them $1 million to invest, they would charge you 2% of your $1 million. Okay. So that's going to be $2,000 a year just to take your money. Plus any profits that they make for you, they're going to take 20% of those returns. So these hedge funds, the idea behind a hedge fund, the reason it's called a hedge fund is they're supposed to invest in things with a negative correlation to give you a hedge to reduce your risk. But that's really kind of just in name only. So these hedge funds will invest in mutual funds and different stocks and ETFs. They might invest in some real estate. They might invest in a lot of. They might invest in options, put options and call options, which we haven't gone over that yet. But they might invest in derivatives and commodities, different options. They might invest in artwork. So they invest in just all sorts of different things to try to beat the market. So that's what a hedge fund is. If you ever read about scandals there's this show on CNBC called American Greed. The majority of the shows on American Greed are about these hedge fund managers, these hedge funds that have blown up because they've lost money and are taking people's money, scammed people out of money. Because what happens is they end up, the typical situation is that this hedge fund starts and they get to a quarter or they get to the end of the year and they haven't beat the market. So they're worried about people taking their money out. And so they'll make up numbers. They'll make up these fake statements showing people that they have made a higher return than they have. And then they'll try to make that up in the next quarter or the next year. And it's a snowball effect. It kind of becomes a Ponzi scheme. Bernie Madoff, that was a typical situation with Bernie Madoff. That was the biggest hedge fund that blew up and he's in prison now for the rest of his life. Anyway, these hedge funds can get into trouble. So you're all familiar now. You've probably all heard about the GameStop thing where people on Reddit talked about GameStop and people on Robinhood. Basically, that was a grassroots effort to to really screw these hedge funds because there were these hedge funds that had shorted GameStop. And a lot of people felt that that was unfair, that these big institutional investors and these big hedge funds are shorting GameStop and running it down into the ground. So there was this grassroots effort to buy GameStop. And so it really did work. This hedge fund, this one particular hedge fund, lost millions and millions of dollars because they were short GameStop. So that was actually kind of satisfying to see because it isn't a level playing field a lot of times against these large investors. And so it is kind of satisfying to see that the little guy can wield some power when we get together. Okay, so anyway, that's enough about hedge funds. Private equity funds, uh, that's if you put your money with a private equity company, those are those are investment companies that are trying to find the next Apple or find the next Microsoft, find the next Tesla or the next big company. And so basically what they're doing is they're angel investors. And what that means is they're looking at small startup companies to take public or to invest in and then eventually take public. So let me try to think of a company that recently went public. Um, well, there's a company that you might look at called Confluent, CNF, see, it's CFLT, I think is the ticker, Confluent. They just went public. And so what happened is they were, it's a small company. It kind of competes with Oracle. So it's a Silicon Valley based company. They had this private equity fund that invested money in them at like I was reading about them. These original investors in this private equity fund invested $3 per share. They bought their shares at $3 per share in this company. And a lot of employees also invested. They got stock, $3 a share. So then they wanted to raise all this cash. And the company has gone up in value. And so when the company went public, it closed the day it went public and had their IPO, which was just last week. That was like June 20 something, 2021. It closed at $45. So that's a success story. Imagine that you have put your money with this private equity fund. They find this company, they buy the shares, they invest in this company at $3 a share. It goes public and you could sell your shares at $45. So that's a success story. But these private equity funds might look at 100 different companies before deciding to invest in one. So anyway, so when you think about these private equity funds, those are funds, again, just to wrap this up and summarize, those are companies that are looking looking at new products they're looking at new companies to invest in. And so they might find a sole proprietor that has a new product and they'll invest in that company. And then when they think that it's raised enough money to where they can really make a big profit, they'll take it public. Another company that's about to go public is called Oatly. You can follow that. Oat milk is the big rage right now, supposedly. I don't know if you've tried oat milk or not, but Oatly is a privately held company that people have invested in, and it's about to go public in the next few months or so. So we'll see what happens with that. It's very risky when these companies go public, though, not for the people who were the original investors, but for people like us who are buying it on the secondary market once it's gone public. They usually go way up and make a bunch of money for the initial investors, but then it can be quite volatile. So you have to be careful as a secondary investor like we are buying these shares. So for example, I was thinking of buying Confluent. It went up to $45. It closed at $44, $45. It went as high as like $55 this week, and now it's down around in the mid 40s. So you really, they've yet to turn a profit. So it is risky. But anyway, so that's a synopsis of hedge funds and private equity funds. Just different ways that people try to make money in the markets. Okay, now what if you wanted to invest in foreign companies, foreign and so forth? So we already talked about that with the foreign indices with these ETFs. You can also invest in mutual funds um, that invest in foreign companies. And so there's international funds. So I think I mentioned this in the prior chapter. An international fund is a fund that invests in companies outside the U.S. A global fund is a fund that invests in companies outside the U.S. and U.S. stocks. So it's global. Then you can invest in a regional fund. You can buy mutual funds per region or per country. You can also buy emerging market funds and emerging market ETFs too, by the way. Um, that those are an emerging market fund would be a fund that is investing in India, Brazil, developing countries. iShares is a company that has mutual funds and ETFs. These you can Google iShares and you can see all the investments, all of the funds that they offer if you're interested. Okay, so that's it. This I was got a little longer winded than I intended on, but that's usually the case. So hopefully this just gives you a nice synopsis of what's going on in this chapter. Okay, take care, and I'll see you next time.